Welcome back to Fast Market here on the TD Ameritrade Network. It's our cash tag segment. Let's bring in our next guest for that, and that's going to be Landon Swan, co-founder at LikeFolio. Welcome back to the show, Landon.
Thank you. Good to be here.
All right, so we're talking Netflix, and, you know, this is not part of the Magnificent Seven, which is why I've renamed it the Elite Eight, because I think maybe it should belong in there. But this stock, since bottoming out in May of 2022, it's just been on a parabolic move to the upside here. Do you have the data that supports it? Because it seems like they're winning the streaming wars. It seems like Disney Plus has got problems, Warner Brothers, Discovery, Paramount, they've all got problems, cost problems. But Netflix seems to be the winner here. Does your data support it?
Yeah, I tell you what, this stock has been on a run. I mean, even just in the last week, this thing's up 40 points, right? I mean, it's up 10%, which is basically the expected move on earnings. It's already made it this week. So pretty interesting. And it's having a little trouble up here at the 480 level. I guess it kind of hit a little resistance, but a very strong run over the last little bit. And yes, I would say that they're absolutely the leader. I think that's hard to deny. I mean, they've come so far over the last decade, and they are by far the #1 streaming service. They're the ones to beat. Now, when we look at the data, though, and you look at, on a year-over-year basis, how is this company doing? How are they doing versus their peers? We can actually see that our data does not support a huge run here. In fact, I'd say that we're even leaning a little bit bearish, especially considering the run that they've gone on. You can see some of the comparables here. Now, keep in mind, this is year-over-year change. So, there's high marks high comparables a year ago for Netflix and lower ones for Disney, HBO, and the others. So they're easier numbers to beat, but still they're making headwinds when it comes to consumer demand. And this is not, number of subscribers. This is just sort of social chatter about signing up and interest in signing up. So these are sort of new customers or excitement around becoming a new customer. And if you look at happiness, the chart's almost exactly the same. I mean, it's Disney and HBO at the top, Peacock at the top, and Netflix sort of at the bottom. Now, some of that may have to do with the password crackdown. People don't like that, of course, those that we're sharing. But overall, I think that the data is showing that Netflix is a little softer than the stock run has shown us. Even when we look at the web data, I mean, Netflix.com, which is not the perfect measurement because you don't have to go to Netflix.com to view, but you do kind of have to go there to sign up for the most part. And that's actually down significantly as well on a year-over-year basis. So web visits are down, social enthusiasm around signing up is down. So we're a little bit, we think this is a little bit soft going into this report. But there's a lot more in this report, right? There's a lot of stuff that's going to be talked about that we have no insight. So first of all, I just talked about the password crackdown. Their investors are going to want to know how much has this boosted revenue? How much has this, cut down on the sharing of passwords? Another thing is this new ad-supported tier. How well is that doing for Netflix? Because they've got it basically a much cheaper. I'm not sure if it's free or cheap, but it's you get served by ads, and that's how you pay for the service. If that's doing well, I wouldn't be surprised if Microsoft gets a boost. They're the sole provider of that service to Netflix. And then finally, you got the strikes going on, which is kind of it could be a positive for Netflix because they're going to be paying obviously a lot less when it comes to content creation if they're unable to pay any of those services because of the strike. So costs will go down, but then you've got delays on some of their big hits like Stranger Things that people are waiting for. So pros and cons there, but I know that they're going to be licensing additional content from HBO. One show in particular that I saw that they're going to get was Band of Brothers. If you guys haven't seen it, a big World War II guy. It's a fantastic series. You can check it out on Netflix now. But just overall, I think this is going to be a lot deeper than how many people signed up. The earnings call is going to be a lot more in-depth than that. But what we have is that those numbers are going to be a little bit soft and not supportive of a $480 stock price.
Landon, very quietly yesterday, Evercore upgraded Pinterest. And what the reason they upgraded them was they said that ad spending is starting to tick back up again. And it looks good for a lot of these names. Now, that's just one aspect of Netflix, but that could be a really good sign for Netflix, but it could be a good sign for a lot of these companies that depend on ad spend for generating their revenue. Now, here's my question. of these three things, then you just went over all three of them. It's the ad-supported revenue, it's the password sharing, and it's the strike, frankly. Which one is the most important in your opinion or your data? Which one do you think is the most important for their earnings call?
I think for sure it's ad-supported content, because the other two are temporary. I mean, the password crackdown's temporary. The strike is temporary. That's not going to be here a year from now, but the ad-supported tier could be. And if it shows that they can increase revenue and gain a whole new customer base that are much more price sensitive, that's going to be very bullish for the company, obviously. Now, to your point, when it comes to ad sharing, I will say that there's going to be a lot of companies that are going to be impacted by this report. Microsoft won for Netflix, but then also just the entire, I guess, world of it. If their ad-supported subscription tier does really well, I would also be very bullish on TTD, the trade desk. I think that that's the company that we're very bullish on at LikeFolio for a lot of reasons. But this could be another proof point for them, even though they're not the customer. They're not the service provider, for Netflix. Microsoft is, but it's still kind of a proof point for the concept.
They just came out today. Netflix says basic plan, that $9.99 one, no longer available for new or rejoining members. I know a lot of people cancel a subscription, go back on a specific plan, but that's gone now. Ad tier is $7 a month, standard $15.50, and then premium nearly $20 here. So maybe that is a bonus for the revenue if they don't offer that anymore to new or rejoining members. But Landon, when you look at this, is this something where Netflix is a leader? They've got the most subscribers, over 230 million at this point, where these other companies that are losing money hand over fist in the streaming space go back to just more licensing. You mentioned Band of Brothers, amazing. I watched watched it when it came out, but is that what they maybe should be relying on? That, hey, we've got this other streaming thing where we can sell our content and license it to them, where that maybe gives them Netflix an even better edge?
Right. So I think that, one of the things that Netflix has kind of discovered over the last few years is, the race for content. I mean, we saw Disney fall behind tremendously in the race for new content, and it's very, very expensive. And now I think they're all starting to get a picture into the headaches that can be caused by this content. Not only is it very expensive, but all of a sudden you've got the potential for strikes and slowing things down. And if you're reliant on that new content, the new season coming out, then you're very susceptible to that. So I think it's going to potentially change the model where they're going to be licensing a lot more than creating. I think, if it's me, it's just so many headaches around creating. Why not just license? But somebody's got to create it out there. So that could be an interesting play to see who does that. But yeah, Netflix got into that game a few years ago and really did well in it. But that's always been a focus of expenses, and people are, investors are very concerned about how much they're spending. So I think that I think the strike is going to be kind of a relief on the expense side, because they can't spend money there. I don't know if they're going to lose a lot of customers. I don't think so, because the Stranger Things season is postponed, or some of their other original series are postponed. I don't think they're going to lose customers there. They're doing a good job of licensing. So it'll be interesting to see how that plays out. But again, that's temporary. The password thing's temporary. I think the focus for investors, at least for me, is how is the ad-supported tier doing with customers? Are they resonating with that? Are they signing up? Are they sticking on? And how much money is Netflix making per user on that plan versus some of the other plans? Because maybe they're more profitable with the ads that are being served. I want to hear that.
Yeah, revenue per user is supposed to increase more than 5%. But Landon, real quick, do you have an earnings score on this one going in?
Yeah, we're negative 37, and with the stock running as much as it has been, I think we're a little bit more confident in that than we would have been. All
right, great stuff, great data as always, Landon. Appreciate it.
Thanks, guys.
All right, that's Landon Swan, co-founder of LikeFolio, breaking down the data for us. Kev, lots to go over here. Tricky one, because expectations are really elevated, and as you mentioned, anything that goes wrong could have a negative or a positive impact.
Yeah. I have no idea where the stock is going. Zero.